You know, it's kind of scary to say anything negative about Tesla these days, simply because its share price has shot up so much. It's undoubtedly rewarded a lot of people and made many people fans of the business itself. Tesla is indeed going to be a market leader and a dominant force in the battery space, in the EV space in many years to come. I'm not challenging that. I'm just trying to put some perspective to numbers because maybe that's not frequently mentioned enough. I'll hope to value add in that direction. But today's video, I'd like to make some useful comparisons for you. As well as today's title, why you can actually wait. Because if a good company comes at a better price, follow good investment philosophies and you'll be rewarded. You'll stay safe, even if it means missing out on the next big thing. I'll make comparisons with Amazon. I'll make comparisons with Apple. I'll try to make comparisons with even existing car manufacturers to give you some perspective as to price. Because every good thing also comes with a price. Hopefully you agree with me on that, and we'll roll in the intro video. Hi guys, welcome back. Now today my main objective is to really put some numbers to things, to the story itself. But let me start by saying, I do understand that Elon Musk is one of the most important entrepreneurs right now in the world. I do understand that Tesla's mission is very admirable, that we should all support it. If you haven't time to look at it, let me pull this up for you to see. Tesla's mission is to accelerate the world's transition to sustainable energy. That's going to help everybody. But at the same time, a good cause does not equate to a good share to own. So let's keep things separate also and be objective. Now also understand that many who have betted against Tesla seem to have been getting it wrong. The latest is Michael Burry. Time will tell whether it is indeed overinflated as he claims it to be. Now, why are we trying to put price to things? Now, deep down, I'd like to ask you this question also. How often have you bought something without looking at the price? Almost never, right? You buy a piece of shirt, you buy something, you try to put a value to things. It does feel a bit weird when you buy without looking at the price. And same with investing. Hopefully, the story, however loud, however sexy it sounds, you remain critical in terms of your thinking. And with this discussion, maybe you have a bit more point of view. Now, I also want to pull back up, what does the stock market do very often to investors? Now, this is actually the share price of Tesla. And what do you realize? Market undervalued Tesla back in 2019. I think that's pretty obvious as of now already. Market has this tendency. They underestimate the potential of a company. Share price very often reflects the potential of a business, of a company. And 2019, Elon Musk was still Elon Musk. He wasn't a different person. 2019, Tesla's mission was the same. So in a lot of ways, 1 year plus doesn't change a business that often. The potential remains the same, and very, very clearly market is underestimated. And while market underestimates something's potential, very often they also overestimate the potential of something. So do keep that point in mind and run through this critical discussion with me in today's video. Now, today's discussion really about price is all about potential. Hopefully you do understand there's no right or wrong. Anybody putting a number to it is also making a calculated guess, and I have mine to share with you today. Now, as of January, this is Tesla's numbers. Price is actually about $850 and price earnings ratio of about 1,600 plus. Now, that is a big number, and just in case you don't understand what is the impact of this price earnings ratio, imagine this: if you own a company and you want your capital back through earnings only, what it means is if the price earnings ratio is 1,600 plus, it takes 1,600 years for the company to milk out enough earnings to return back your capital. Now that seems like a big number, correct? And also understand that Tesla is a turnaround story. It has been bleeding money, and recently only then it started showing profits. For the last 5 quarters, Tesla has shown profits already, and it's turning around that curve, which means this 1,600 plus price earnings ratio does not seem a lot of use, and I understand that. Let me try to do some adjustments. I've actually dug up some research, and this is one analyst forecast. And what we can see over there is price earnings ratio is going to drop sharply simply because the earnings per share is going to be good for 2020. And what do we realize? The projected 2020 earnings per share is close to $1, which is a double from last year because last year had some losses. So if we try to do some adjustments, the 2020 price earnings ratio would fall to 850 plus if indeed the earnings per share is $1. Now let's use back the earnings forecast from the analyst report, and what do you realize is 2021 it's expected to be a fantastic year for Tesla. So I do believe that analysts can forecast for a year forward because a lot of things are baked in. And what we can see is a tremendous growth, possibly a $3 earnings per share. That means a 300% jump from 2020 to 2021. I think that's fantastic. And if we put that figure into the table that we see, at current share price of $850 thereabouts, the P ratio will fall further to 283. Now, while that number is big, in the next section, let me put Tesla in comparison to some of its peers. I'm back and I'm changed. Now, if you have benefited, smash your like so more people can see valuable content like this. And again, inviting you to press on the subscribe because in the next few weeks I'll be launching videos that touches on fear of missing out, how you can handle it to become a better investor, as well as my dividend stock pick for 2021. If you're interested, subscribe and stay on for it. Now, let me pull this out for you to see. This is actually the industry peer comparison between all automotive companies. And as we can see, Tesla is measured up against Toyota, Volkswagen, as well as NIO. Now, what is the first thing I'd like to draw attention to is actually the 5-year annualized revenue growth rate of 50%. Later, I'll be using it for further projections, so keep that in mind. But I'll firstly touch on the valuations for Toyota and Volkswagen, which are the two biggest car manufacturers right now. Toyota is valued at 200 billion, Volkswagen at 80 billion. And to really put things in perspective, NIO at current market cap size is at 90 billion. Now understand that Tesla and NIO are probably the leading players for EV, electric vehicles. But the old players are surrounding this pie currently. If you try to understand my point of view, is that this pie of automotive sales is only that big. It's not changing 100 times. It is just that these electric vehicle players are taking over this pie. Tesla and NIO, they are eating up this pie from Volkswagen and Toyota. Make sense? If you agree, leave it yes in the comment sections. Which means if NIO, being valued at 90 billion, is already the second biggest player if we don't include Tesla, behind Toyota only, which in my opinion does not make sense because they have not achieved that at all. So to me, that is a big stretch in terms of valuations. Also, if we were to assume Tesla will eventually become the number one player, that means it will take over the pie that Toyota is owning right now, and that only is 200 billion worth. Now, at current share price of $850, Tesla's market cap is $800 billion. That means there is quite a lot of excess that's not factored in by car sales. And that's really assuming that Tesla will eventually become the number one player. We haven't taken into account competition. I'm sure you've also heard Apple is also trying to move into the electric vehicle space. They have their own ideas on it, and it's not a guarantee that Tesla will eventually become the number one. So putting 200 billion in terms of the potential that it can grow to is already quite a stretch in my opinion. Now, I know what Tesla fans may be thinking of, or what you may have seen before in other analysts, is that Tesla is not a car manufacturer. They should be an energy player, correct? Even famed investor right now, Chama Palihapitiya, he's mentioned also that Tesla, its first wave of growth will be through vehicle sales. That was in 2016. He's correct. You eventually become 1 trillion company. He's almost correct already. So in some ways, it is true. But let me show you some factual numbers. This is from annual reports. If you haven't seen Tesla's annual reports, if you want to be serious in investing in Tesla, you should at least dig up their numbers and not just listen to what a YouTuber will present, like myself. Dig up the numbers for yourself and think critically. But I'll shortcut that for you. I'll show you the numbers so far. And what you can see is actually the bulk of revenue is still coming from automotive sales, correct? That is the bulk. The box in red is actually energy sales, which means battery, while it eventually will be Tesla's main business, is still very much at infancy state. It has not achieved anything. We are still very much thinking about its potential. Everybody is trying to make a calculated guess to its potential. In fact, the growth rate for the energy does not seem that spectacular in a lot of ways, but that is a separate issue. So with that, is Tesla's 50% growth rate in terms of revenue going to extrapolate for a very long time? I think that is up to anyone's guess, but I would like to help you understand comparisons with Amazon as well as Apple. The way that I'll be measuring Tesla against Amazon and Apple is using the price earnings growth ratio, PEG ratio. Now, this is actually coined by Peter Lynch, and he's an investor into growth stocks. As for Peter Lynch, he actually advocates for PEG ratio to be less than 1 for it to be considered within his buying range. So today I'll give you some numbers as to Amazon's as well as Apple's. And let's start with Apple. Apple's growth rate 5-year annualized for the revenue is at 10%. and its current PE is at about 35 times, and the PEG ratio is 3.5 times. What about Amazon? Amazon is having a faster growth rate of 30%. Its PE ratio is 90 times, which means the PEG is 3 times only. So while Amazon is having a higher PE ratio, it also has a higher growth rate. Using the PEG ratio, we can actually equalize things, and with that, I'll measure it against Tesla. Now, as we have discussed already, if we can forecast quite confidently that earnings per share is probably around $3 for Tesla in 2021, that will be the basis whereby we work back as to the potential price for Tesla. I'm not plucking numbers out of thin air. I'm using various findings that I've sourced out along the way to try to give you some realistic numbers to things. Now, if the PEG ratio is measured against Apple at 3.5 times, Tesla's share price should be at $525 only to be considered a better investment than Apple, simply because PEG is measuring against growth also. Apple has lower growth, Amazon has faster growth, Tesla has the highest growth of them three, but the price is it too expensive? What if the PEG ratio is reduced to 3 to match it against Amazon? You realize that the price for Tesla would fall to only $450. Now, as I mentioned just now, PEG ratio should be 1 or less to be considered cheap. So in a lot of ways, all these three could still be expensive. There could be a lot of perspectives as to what is the right price to get in. In a lot of ways, I do believe that things could be inflated. That is my sensing of things, and that's why I derived this personal sharing as to why I would rather wait out for Tesla to be at the right price before considering it as an investment. So with that, hopefully the presentation rounds up. It really is a deep research that I've done so far, and to put numbers in perspective, because I've been seeing wild numbers thrown all over the place, really putting too much optimism, and hopefully this sharing gives you more perspective. If you benefited, smash your like again, and I'll see you in a future video. Take care and goodbye.